Category of market patterns. For this lesson, I'm going to use charts to show examples of market patterns. First, though, I'm going to explain double top and double bottom. Now, the double top pattern occurs really often in the market. And as I explained in the lesson on market patterns, the double top pattern has two tops, which also act as resistance zones, and the neckline, which acts as a support zone. I showed some illustrations of a double top pattern and other market patterns too. So let's use the chart to identify a double top pattern. This is the US dollar against the Japanese yen currency pair, and it's in a 4-hour time frame. You can probably spot the double top pattern, right? The price has reached 105.650 and then dropped to 103.650. So the market on this price level has a strong support zone because of the momentum of buyers in the market. The price changed the direction by going up and then reaching the price around 104.800. The price couldn't go further up, so the first stop of the double top pattern was formed. The first top now acts as a resistance zone. The price created the neckline, or the support zone, at the bottom. The momentum of buyers shifted the price up by testing the first top and the first resistance, but the resistance didn't break. The second top was formed, which then acted as the second resistance zone. The price decreased and tested the neckline, and as you can see, the price is still continuing down. Now, this is an example of a double top pattern in the market. The resistance zones, or the tops, are highlighted with a white horizontal line. The neckline is highlighted with the yellow horizontal line. The price is now around 104 level. As you can see, the support zone created by the neckline wasn't broken. The momentum of buyers on the support zone shifted the price up. The double top pattern is now completed, which makes it a valid double top. Okay, now let me show how you could trade the double top pattern if a similar market pattern example occurs on the charts. Now remember, the market doesn't always go with your predictions, and you need to be prepared. In this example, I'm showing an ideal scenario on how to trade a double top pattern. Since the second top and the second resistance were formed, these indicated a possible bearish momentum in the market, and a sell order would be the best scenario to trade. First, the stop loss should be above the resistance zone. So as you can see, I've highlighted the stop loss price above the wick of the candle. There are situations when the market retests the highest wick of a candle on a resistance or a support zone. So I've placed the stop loss just above the wick of the candle. My entry price of the sell order is around 104.550 level, and the stop loss level would be around 104.850. So the risk of stop loss, if it gets hit, is about 40 to 50 pips. And as you can see, the market has reacted according to my predictions and is going in the right direction. I've set the take profit level at the neckline of this double top pattern, which is also a support zone. As you can see, my prediction was correct because the market reacted bearishly by testing the neckline of the double top pattern. Now, this example shows how to trade a double top pattern safely. And in this scenario, I would close the trade with over 70 pips profit. I'll show other examples of the double top pattern using the charts, but for now, let's focus on the double bottom pattern. Now, a double bottom pattern has two bottoms that act as support zones and a neckline which acts as a resistance zone. The break of the neckline can signal a potential bullish momentum in the market. So let's use the chart again to identify a double bottom pattern and how you can trade it. I used the US dollar against the Japanese yen currency pair to show an example of a double top pattern. Note that besides the double top pattern, a double bottom pattern is on its way to forming completely. A double bottom pattern has two bottoms, and here on the chart, the pattern shows two bottoms, and at the top is the neckline, which acts as the resistance. Now this is an example of a double bottom pattern, but it's not fully formed yet. Even though the price created the second bottom and it's going up, this is not a 100% double bottom pattern because the price still needs to test the neckline again. So the price can change direction by going down and breaking the bottoms. From the current chart, the most possible scenario is the bullish momentum. We can execute a buy order at the close of the bullish candle at the bottoms of the double bottom pattern. Now, the entry price on the bottoms would be around 103.950, and the take profit would be around 103.700 to about 103.600. So a 30 to 35 pip stop loss because of the wick of the candle near the support zone, which can get tested again. The target for this trade would be the neckline of the double bottom pattern, which is the resistance zone around 104.670 level. So if this analysis works, then this trade would gain over 65 pips. You should always remember that the Forex market can go against you even if the analysis is done correctly, and this double bottom trade could fail. So always use a stop loss to protect your trades. The examples with double top and double bottom can be different when you try to trade them on your own because of other factors in the market. However, relying on the examples I showed is a really good method to learn how to trade double top and double bottom patterns. Since I explained how to trade double top and double bottom patterns, let's identify another double top and another double bottom in the market. With the double top pattern, sometimes one of the tops is higher than the other. So identifying double top patterns with one of the tops higher is really important. For example, here's a double top pattern on the British pound against the New Zealand dollar currency pair in a 30-minute time frame. Two tops are created and the neckline really isn't very far from the tops. The right top was formed on a higher price level than the left top, which was the first top created. So this double top pattern is valid even if the tops aren't on the same level. Here's another example of a double bottom pattern which you may not fully recognize as a double bottom. The first bottom was formed, then the price dropped for some pips by testing that first bottom, which is the support zone. The price changed the direction and increased by forming the neckline at the top, which is the resistance. The price decreased then and tested the first bottom and the first support, but it couldn't break them. So it created a second support zone and a second bottom. The price then increased and tested the resistance and the neckline. This is a valid double bottom market pattern that you really shouldn't ignore. When the first bottom was created, the price came down by forming sideways trends for some time. That could be one of the reasons why you can't identify the pattern really clearly. So always keep in mind that even if there's a sideways trend or a long candlestick in the market, which may confuse you, the market pattern can still be valid and should not be ignored. However, if there's a long momentum of the sideways trend in the market pattern, then you shouldn't focus on that pattern anymore. The example I showed with the double bottom doesn't have a sideways trend for a long time, and that double bottom pattern is still considered a valid pattern. Hopefully you've learned how to trade double bottom and double top patterns now. So let's continue with some other market patterns.